Mind Your Farm Business on RealAgriculture.com is brought to you by RBC Royal Bank.
Welcome to episode 6 of Mind Your Farm Business on RealAgriculture.com. In episode 6, we're going to focus on the idea of incorporating your farm versus leaving it as a sole proprietorship, why you should do one versus the other, and what are all the considerations that go into this big decision. Today we're going to talk to Merle Good. Merle's really going to break down the operational and the financial considerations when you decide to incorporate your farm. At the end, Merle's really going to add some value to the discussion as it applies to the concept of succession and the advantages that incorporation can play in having that very successful succession plan on your farm. For some of you listeners out there, some of you probably already have your farm incorporated. This discussion also applies to you as well, because I think there's some advantages or things you need to think about that you may not even be taking full advantage of. You also may not be addressing some of the roadblocks or some of the pitfalls of some people that do incorporate their farm. See, that's the interesting part. Just incorporating your farm isn't necessarily the end of the road. There are some things that you still need to do to make sure that your farm is successful inside that incorporation. Okay, hope you enjoy episode 6. Merle, how are you doing today?
Great.
Merle, in episode 6, we're going to talk about farming Inc. and basically this idea of why or wouldn't I incorporate my farm. So let's start off right there. If I'm farming, why would I want to incorporate my farm?
Well, I mean, that's a pretty wide open question, and we'll try to break it down into sections, I think. Of course, the most logical one on a tax perspective is the low rate of tax across the three prairies. I mean, Alberta, the low corporate tax rate's 14%. I think Manitoba is 11%, and Saskatchewan's about 15%. So at those rates, and that's up to $500,000 of taxable income. And so with those rates, as you know, Shaun, being in the agricultural industry, the volatility of income is just so immense. So the old days, we could sit back and we used to watch trends on farm incomes. Now it's spikes and troughs and volatility, same as the stock market, is huge. So with these low rates of tax, what I'm finding, even on smaller farms, you don't have to be extremely large or extremely profitable to have a company make sense, because you can have an opportunity to sell or forward sell a lot of grain on a short notice and have a lot of income coming in. And I want producers to have that ability to make those financial decisions, not based on tax rates. So what I'm finding is, even if we sit back and say over a 3 to 4 year trend line, your taxable income isn't that high, but what you'll find on average, what you'll find is 1 year you make, $250,000 net, and next year you make 160 or 100. So what's nice about having the company, it's a flat rate, and so we're not using the tax. We use the terminology, don't let the tax tail of the dog, or run the ship kind of deal.
Mm-hmm. Okay, so low taxes. What's another reason?
Well, probably the most important one that I see besides that is, mainly my area is in succession planning, of course, but I want to talk about financial first. Also, one of the deals with companies is on the financial side is creditor protection. And a lot of young farms that I've met, a lot of them have some off-farm enterprises. And so you'll see some young men have went into spraying. And I notice it's interesting, Shaun. What's the average age, do you think, of a commercial sprayer?
Oh, a commercial sprayer. I'm going to guess 35.
You're about right on. And so what's interesting, these young people buy the sprayers, spray like hell for 10 years, and then they're burnt out, right? But so in those 10 years, because it's a separate enterprise, sometimes companies, business structures like corporations, allow us to have a separation of liability. So if your son wants to be into a custom spraying business, I don't want that business part of Dad's farm, even if it is a sole proprietorship or even a company. So sometimes companies are nice to separate farm enterprises from each other primarily for liability issues. Mm-hmm. When I say creditor protection, farmers always jump to the fact, oh, great, I can do something to lower my risk of paying the bank back. The answer is no. And that's something I do want to stress, is companies traditionally cannot be structured by the banks to eliminate your creditor liability to institutions like the Royal Bank, because they take things called personal guarantees. Some of the issues there, to make people understand what I'm talking about rather than just generalities, you can have a limit where your personal guarantee is set to a limit. You can also have a personal guarantee where after so many years it will lapse and you have to negotiate a new one, things like that.
Okay. So those are some financial ones. So we got low taxes, we got creditor protection. What are some others?
Well, on the wealth side, and I spoke at Farm Tech, and you were there that one year, is that with the change in land values and interest rates, it's almost impossible to buy land personally. And I really want to stress this one. If you have a chance of buying a quarter section in where I live at Cremona, it's going to cost you $600,000 right now. If you have to, and you're paying only 3.5 to say 4.5% interest, most of your payment is principal. So to make that after-tax, non-deductible principal payment on a personal tax rate, it'll kill you, right? Because you can't deduct the interest. That's right, you can't deduct the principal. So what I'm finding, when you sit down and look at the cash flow over 20 years required on an after-tax basis to buy the land personally versus buy the land corporately, do it personally, it's going to cost you about 50% more, or 35. I forget the number, but it's very more expensive because you can't deduct that interest. When I was young, of course, the land was cheaper, but interest rates were 16%. So I didn't need to form a company to buy land, Shaun, because the majority of my payment was interest, which, of course, I could deduct on a personal tax basis. So what we're looking at on companies is sometimes, even though we're looking at not huge amounts of off-farm income, I'm looking at new models where that the son is perhaps forming a company before his father, because he has an off-farm job and he needs the company to farm, but also in order to make those payments to pay that land back.
As a side question, is there any sort of demographic difference between in terms of age? Do younger farmers have a different attitude about incorporation versus maybe the prior generation, or is it relatively the same?
Well, I would say they're more open to it. We're talking about age groups, so I'm talking to a young guy who's 25. Of course, what the hell's a company, right? But if they're in their late 30s, early 40s, yes, they're much more open to corporations because they've had 10 years of experience farming now, or 7. And the fact is that they know because of these different options that we'll discuss today, it's in their best interest to incorporate at that generation because they want to buy land. And the big one, of course, and all this stuff is paying off the debt. We talked, at least with machinery, you can depreciate it, which helps you on a personal, non-corporate basis. But on land, you've got to have a company, I'm afraid. And there's been a real stigma of putting land in companies, and I think we have to look at that and get by that. We just can't say, never form a company and put land in it, or never form a company to buy land. I think that's been a misnomer of the last 10 years. We should change that.
So whether you look across when you look across Canada, is that kind of one of those misconceptions? You shouldn't put land into a company, or?
Yes, and I'm going to talk about that. Might as well jump right to it. And so what's really frustrating to me is the accounting profession and advisors have not said to farmers, hey, look, you could sell one quarter section to a newly created company or to your own company, create a shareholder's loan of $400,000 and never pay a dime again of personal income tax up to the $400,000. And what I want you to reiterate in this interview is I got a new concept here, Shaun. Why die with your capital gains exemption? Use it while you're alive to pay no personal income tax. Okay? Yeah, because that way, the vast majority of farmers, when I meet with them on a one-on-one basis, we know that the business is going to transfer to the next generation if there is a next generation. And that next generation is going to get some land. I mean, there's just no two ways about it. So why not sell a quarter section to your own company, create a shareholder's loan of $400,000, pull that money totally out tax-free, which reduces your tax on people who have Canada Pension OAS, correct? There's no OAS clawback now. So you're effectively having the government have no tax from you on a personal basis. The company can roll over tax-free to your son or daughter who's farming with you someday in the future. In the meantime, you control it. It's the ultimate succession plan where you're stripping income out of the business tax-free. You're transferring wealth over to the next generation, but you control it. That's the ultimate model, because I want my son to be incentivized to own property, but I want to control it based on, as you all notice in my seminars, the issues of, I call them the 4Ds: death, divorce, debt, those kind of things, right?
Mm-hmm.
So a company does allow, I think, ability to pull money out of your business on a tax-free basis. I think that's kind of important. Also to manage the amount of income you're pulling out on a tax-free basis. So we're kind of separating the personal requirements of living, on a different basis. So that's one reason I like corporations on retiring farmers, or farmers that are going to, slowly have a next generation enter or whatever. And so that's kind of, in a roundabout way of saying, is that I think we have to readdress that myth. Yes. So putting land into company, never the home quarter. Like, I don't like the home quarter going in, Shaun. That's where I live. But other land, right? Because it's you want that flexibility and you want that individual ownership. I have no trouble with that. But some of the land that you have bought in the last 10 years, and that's the nice thing about this strategy. If you bought a quarter section for $200,000 10 years ago, and now you only owe $100,000 on it, but now it's worth $500,000, well, sell it to your company. Have it assume the last $100,000 of the debt, and you create a shareholder's loan of $400,000.
So whether it's these strategies or a lot of other ones that we won't even have time to get into, is the reality that incorporating, does that allow you a lot more flexibility to do a lot of these kinds of things?
Oh yes, immensely, and and that's but I don't want to make it sound like it's all roses. There's a couple of things I do want to end up with on operational and how to run these things. And this one is not to do with technical, but psychology. Once you form companies, we as individuals have this bad habit of saying, well, the company has got the money. And so I'm not spending the money, the company is. And I see lots of financial mismanagement, Shaun, with companies on a personal basis or whatever, because all of a sudden it isn't you writing that check, it's that mysterious company.
So it has that big operating loan.
Exactly. And so what I'm finding is you have to be very, very, very cognizant of the fact that you will have trouble making that transition from being your own bank account, where you and mom have your bank account. You create this company, you automatically get this corporate Visa card, and you're trying to get points. Then all of a sudden everything is spent through the company, or you kind of lose that financial discipline. I'll say, I guess, the best way to put it. Mm-hmm. And I think it's common. I did it. I'll admit, when I formed my company, it was easy to say, oh, well, the company can buy that with my dad, or no, the company will pay for that. It's not me, in a sense.
Right. And
so that's one of the things I really want to star with double stars, is financial discipline when you have a company. I think that's really, really important to understand that. And then secondly, on the intergenerational ones, is an issue. I know it sounds very small, but it's huge. And that is, what is a corporate expense versus a personal expense?
Right.
It's okay. It's okay if it's just me and my wife and my company, but when you have intergenerational owned companies, it's really, really, really critical to have a strong conversation about what will and will not be a corporate expense, and to what limit. And the next one is, what vehicle will the company provide, if any? Like this one family I met, Camrose. After 2 meetings, we've decided the company will purchase a truck for both generations, but the maximum truck it will purchase is $30,000. So if Dad wants to buy a Lincoln Navigator or something, well, then he's got to put up the money. So things like that, because it's hard to have that financial discipline when you have a company.
It's sort of ironic that we have to mention financial discipline and people having, because it's very, very common. We'll have the company pay for it. Yep. It's very ironic, though, that at the same time people forget about that thing we talked about earlier called that personal guarantee. Actually, it is your money.
Of course it is, and it's all tied up. But it's just human nature. I mean, it's. I haven't met one yet who did it perfect. I don't think you will. It just takes time to understand that, of what the company is providing and what you are providing. Like I say, if it's just simply mom and dad, it's not quite as bad. But when you start adding a generation, or especially two brothers in one company, or even into a joint venture of corporations, it's really, really critical. I think we need to spend much more time on helping producers list what is and what is not a corporate expense. Utilities are another example, right? Personal gas. I mean, the list goes on, Shaun, but we need to spend some time on this with our clients to help them make those determinations.
Makes a lot of sense. Merle, we've talked a lot about why you would incorporate and some of the things you need to be aware of. What are the situations where you wouldn't incorporate?
Well, I think, you have to be realistic. I mean, these things are costly. They cost you 50% more on average to get a tax return done by a company, by your accountants. So that's there is a cost, an annual cost, of course. And then your annual continuation fee, which is about $200 a year. So, I mean, your accounting fees and legal fees will increase. And there is one trap, which I have to talk about, which is really, 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 really important to understand. Probably the most important part of the talk today of why you have to be careful with your companies. If you are successful and your corporation has more than 10% of its fair market value assets, so I'll say this again, if your company has more than 10% of its assets, not farm assets like cash in the bank or term deposits or even worse, stocks in the stock market, once that number breaks 10%, you are no longer a qualified family farm corp. And that is huge. If you don't qualify for that definition, when you die, your shares cannot roll over to the next generation. And we do I find a lot of farmers are offside of that test. It's called the all is substantially all test. I think it's unfair that test is in agriculture. I'll give you an example, Shaun. If I have a company that's strictly an operating company and owns just machinery and inventory, and it's worth $1 million, and I have $100,000 of off-farm investments in that company doesn't qualify. If I put all my land in the company worth $3 million, well, of course, I'm onside, right? Because 10% of $3 million is $300,000. But so if Mr. B has everything in a company, he's a qualified family farm. Mr. A, who has the same amount of land but just an operating company, which I like better, then, of course, he's offside.
One of your specialties is succession. So how does this discussion of should we incorporate versus not incorporate, how does it apply specifically to succession?
Well, I think we'll end up with this section of the box. Succession to me is defined as transferring the business, where estate planning is transferring your wealth. And I know that sounds kind of weird, but I really believe that. And so a corporation to do succession is almost required on these commercial farms today. So what that means is the old days of saying, well, you can have the cows and the machine and the inventory and the grain when I die, or transfer it to you over time, doesn't work because of the non-structured transfer. So in a company, once we have a corporation, is ability for me to have mom and dad slowly live off their equity. And so I'll kind of make this very important to understand by your clients and your audience. When you put assets into a company, you get things called preferred shares back. So if you put $1 million of inventory, you get back $1 million of preferred shares. So what that means now is when the company is now structured between you and your child, as time goes along, the company buys you out, not your son. So the company, over time, say $1 million, gives you $50,000 a year to live. Well, you effectively then, at the end of 20 years, that company has bought you out. And the corporation, if we structure it properly, will then be owned by the next generation, or substantially owned by the next generation. So it's a very formalized, understood methodology to have parents retire on their equity. And regretfully, that's what the intergenerational farm is all about, in a sense. Why I say regretfully is that a farm, this is very important to understand, in intergenerational farm transfers, very, 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 very few farms can pay a rate of return to the parents. So if you got a $2 million company and you want 5% return, well, there's $100,000 off the top. And what happens after 20 years, you still own the company and your son owns nothing. Yep. Because you've stripped it of all of its earning power as a rate of return, like a dividend on the TSX. So what I want to stress is I say to parents, if you're going to do succession, there's 3 rules. 1, you will die with land, Shaun, so you have some security. Number 2, you will retire on equity, right? And number 3, that we will structure this so that on your final demise that your son the operating business company will have access at least to land that may be left to non-farm children. So we have an access agreement. So those are my three pillars, I think, in succession with companies.
Yeah, so the reality is whether you're thinking short-term operationally or long-term from a succession or estate planning standpoint, there's a lot of considerations as it applies to whether or not you should be incorporated.
Yes. And regretfully, I think people are put into it too quick without understanding anything else. It's you do it this way. You bought the air seeder and your kid's not home. How do you run the damn thing?
Yeah. Yeah. What are all these monitors? What's going on here?
Yeah, so it's just like that. So like if you buy the company without understanding it, it's like buying the air drill without understanding how the monitors work. And so you got to spend some time on the manual to truly get your full benefit out of your air seeder, to get the full benefit out of your company.
Merle, thank you very much for joining us today, and we'll talk to you again soon.
Okay, bye.
Now, I know there was a lot of information in that discussion with Merle. You may want to listen to it again and take notes, or maybe listen to it with your farm partner, whether it be your father, your mother, your brother, your sister, your own child. Maybe it's even a non-family member. Listen to this episode all together and really, really talk about some of the things that Merle discusses. One thing I love about talking to Merle is the anecdotes and the experiences as he has had with different clients and how he tries to help you make better decisions. I really hope you enjoyed episode 6 brought to you by RBC. I really enjoyed talking to Merle. Great to catch up with him. I hope you'll join us in episode 7 of Mind Your Farm Business, where we'll talk about managing currency risk. Talk to you then.